Hey, it's Scott with IWR Invest with Rules Advisors. And I want to come to you today to first say thank you for being a valued client, talk about some of the risks that are mounting in the macroeconomic environment and what we're doing about it. And then, number two, as we are approaching the end of the year, talk about some year-end financial planning ideas for you. Let's dive in. We have a fun agenda. Here we go. Okay, perfect. So IWR Advisors, our Q3 update, and we're so proud and thank you for the opportunity to serve you with trend following investment strategies and deep financial planning. So if we've helped you in that regard, thank you. And if you do need any assistance or some questions around your mind, please reach out. I definitely want to be helpful to you in your financial planning and overall finances. That's really important that we're helpful to you. So now I want to talk about risk, and risk is starting to mount again. There's volatility is slowly picking up. You're seeing some pressure in the markets that we're going to talk about. And our mission very much remains to help you, specifically in severe bear markets. So when those situations occur, like a 2022, like a 2008 type event or a dot-com type event, we really want to follow the trend, follow risk management rules so we can navigate that significantly better so it doesn't disrupt or, in essence, uproot any of your financial plans. That is our number one mission, and thank you for letting us serve you that way. At the end of March, things were really ugly this year. And what was really interesting, we actually had a bear market, kind of hard to believe. The market's climbed a lot since here. But back then, if you kind of put yourself back in that position, it was the end of March, early April, and tariffs were on the table. And this was before the 90-day pause. And it was a fast and furious, very similar to 2020, where the market was just kind of unbelievable volatility on a short period of time. And I remember thinking back in that moment where we were following trends and we started building lots of cash and playing lots of defense. And I remember people started asking me, like, what do you think? And what's happening? And what's gonna go from here? And it was interesting because you saw for the very first time interest rates actually go up when there is so much uncertainty, and the government has a lot of government debt that they need to refinance. So you saw Washington, D.C. kind of move those tariffs 90 days forward and kind of make it more streamlined. So when you kind of look back, we've had this great recovery. And what I want to share with you is just kind of behind the curtain of what we did and how we do it. So we are, again, no one's perfect when you're talking to kind of a buy and hold strategy. It's not fun being down 20% and having this uncertainty and having this unknown. Like, could you have lost more than the 20%? So again, if the tariffs didn't pivot pretty quickly, that was a real reality. And you see that at the beginning of the year, this is our exposure to how much we were invested. So it could be anything, even in a diversified strategy. So we started the year at 75% and we climbed into the 90s. And then we really started decreasing exposure down to 50%. And we went sub 25, almost 20% exposed to the markets. And we were actually at that point, we were in gold, we were in foreign assets and some healthcare stocks. So when this got really nasty, and luckily the market didn't kind of do the 2008, it went go from 20 to 30, 30 to 40. We got another V-shaped recovery, and you can see how quickly we got reinvested. Now, the way we do it very simply is it's commission-free trading, and we're using primarily very diversified ETFs and or individual stocks that very large funds are accumulating. So you can kind of see how quickly we ramped it back up to 100%. Then you got your kind of your break even if you were buying and holding, and we were back up there too. So there's going to be times where we are very much aligned with the US markets, and there's going to be times where we have absolutely very little to no correlation, no market movement similar at certain times as well. Now, I wanted to share really quickly where we are today and why we have decreased some of our exposure as the market was climbing, and then now you're starting to see a pullback happen. So the first thing I want to share with you is some of our research and trends. So we follow the trend, we follow big money, we follow risk management rules. And very simply, you're seeing the momentum stocks of the S&P. So if you take the 500 largest companies in the US, you take the top 100 that are sharing the most momentum over the past 6 months, that has now, in essence, gone from a gas signal, which I'll circle here, to a coast signal. So the short-term trend has now broken. You're now below it. So that, in essence, has us take half of that position down to de-risk. Because what if it gets worse? And if it got the market worse to do another rally back, we could always add it back. But very simply, we do not want to be a part of a very large market pullback. So the market is under pressure now. I want to come to you and share this with you. And the one thing I would say that the international markets, the US dollar luckily has been is starting to make a climb, which is not great for risk assets. It pulled back a little bit today. So international remains on a gas signal, short term and a long term uptrend. So it's still in this green area, but we're watching it really close. Next, gold. We've had a great run in gold, silver miners. It has been a phenomenal trend that we were able to catch utilizing our process. So we ran it all the way up. With silver miners in particular, we did do some selling into strength. We've done that with a few stocks as well, given how extreme the bull market was at one point. But now gold is actually back on a coast. So short term is now down, long term is up. So that tells us to take a little bit off the table. But it has been a great reset. And this could easily keep going or it could fall apart. The beauty is no one knows the future. We are following trend, we're following math, but this has been a great trend as there's been a lot more investments that were moving into gold versus US Treasuries as the US debt has really staggeringly increased, and we'll look at that soon too. And then finally, there's some serious pressure on Bitcoin. We've had several trades of Bitcoin. Bitcoin is kind of some people call it digital gold. Some people have other names for it, but in reality, it's a distrust with the system. But there's also now that it's becoming more friendly to the government and friendly to large institutions, it's acting sometimes like a tech stock in some capacity. So we have taken all of our gains off the table in Bitcoin. Some trades, I think most of them, I think it was 4 out of 5 trades have been up this year in Bitcoin, but now we're in a short-term and long-term downtrend. So that tells us to protect, and it looks like it's getting more volatile and it's not treating the trend very well. So that tells us to step aside at the moment. So there's definitely risk in the cryptocurrency space. I'm going to keep moving in regards to just talk about the markets, just some anecdotal stories. So I overheard a story from one of my old Fidelity friends that someone was kind of said, just put me all in NVIDIA. When I start to hear that type of mentality, put me all in one AI ticker, we're getting close to more of it. Could it go higher? Sure, but those types of activities are when you're getting closer to the top. Another example is one of the fathers at my son's school said. He just lost a fortune in some of these alternative cryptocurrencies, and he said, "You should go out and buy some one that I've never heard of." That's that's not a great sign. So it's one of those things where there's definitely some euphoria and some pain coming to the market, and people will sell. They will add liquidity, they will sell, but they usually sell at the absolute worst time. So I wanted to stop for a minute and why do we trend follow? There's always this kind of adage is if you miss the best 10 days in the market, you will have misery for the rest of your investing life. But what's really interesting is that statistically, the 10 best and worst days in the market tend to happen in a bear market near the bottom. That's when they come. So the question is the black line is if you just bought and held, which there's nothing wrong with doing that. You can do that complimentary for free as long as you're comfortable with very large potential drawdowns. But what if you missed the 10 best days in the market? That's where you get that red line, which is a totally fair marketing story for those that buy and hold. But then the real question is what if you missed the 10 worst days? I mean, look at that performance. But if you missed the best 10 and the 10 best and worst days, you historically, in this capacity, by trend following, you can beat the market. You can beat the market by losing a lot less in bad scenarios, which is how we follow the trend. So, moral of the story, can you do this? Yeah, you just need a process. You need a lot of discipline. And that's what we do on a day in, day out basis for you. So, I'm going to talk about the future. I wish I could tell you the exact what's going to happen, but we all know that no one knows. But I'll start with the glass. I'm a glass half full type of human, or at least I try to be. And then we'll also talk about the glass is half empty. So, earnings growth. So far, we're getting earnings that actually are surpassing expectations. And that's why the market, or at least the S&P 500, the top companies are holding up decently. You've seen a couple of them fall pretty hard after earnings, but you are seeing, this is from some third-party research, that you are seeing earnings that are accelerating, and typically stock prices follow earnings. So if earnings can keep climbing, then this market could go in theory higher. This is from Jake, who's on Twitter. He had some really interesting analysis that showed back to 2016, if there's 3 red months in a row, then typically you get a really strong push in a very strong market. So 23 months, 48%, 23 months, 86%, 15 months, 46%. So they're getting a little smaller. And then he drew another box and said, could this one be longer? Or he's taken the average, is really what he's doing. So the answer is it's possible. And if that's the case, we'll obviously hold the things that are acting the strongest. And this is from Ryan Dietrich, I saw as well. And this is the sixth bull market to reach year three since 1974. And the question is you are here. And this is totally fine. But the question is the markets that were really sustained past 3 years were after not just a bear market, they were after a great recession or a depression or a horrific crash. I would dare to say that the 2020 pullback or the pullback in March of this year didn't really qualify. It didn't wipe anyone out. The risk is still totally there, and the animal spirits are still there. Now, why do I say that? Why do I think this is my opinion? I follow the trend no matter what with Mike and I. But I would say big picture is you have the market climbing and you have job openings, the job market, the employment market is really lousy and it's getting worse. And there's this new word of AI washing, which is a fancy way for technology companies to fire a lot of people, as there are now people using AI that can reduce the headcount at many companies. So typically, when you see this, a recession is around the corner. But recessions and market pullbacks take time. It's kind of like when a boat hits the iceberg or a boat hits a rock. It slowly starts filling up with water. It doesn't typically immediately sink. What are other negatives that are out there? This is a really expensive stock market. The earnings ratios from any capacity, whether you think about Warren Buffett, I know he's resigning and retiring this year, but he's not even buying his own stock anymore. That's how expensive he sees the market. Tech stocks, some of them have very lofty valuations. Some will grow into them, some will not. But this is a very, very expensive market and a very concentrated market. The top 10 companies now are over 35% of the S&P 500. So even though you think you own 500 companies, you really own just 10. So however those 10 do, and if those 10 keep getting everyone's paychecks every 2 weeks, that's great. But what if that tide turned and people started selling? Or what if the algorithms and the commodity traders started selling? That's going to put pressure on these 10 companies. And if they can't, they're going to have comparisons as they report earnings quarter after quarter. And can they keep spending and can they keep beating? And if they don't, this concentrated markets can be dangerous markets. Also, margin debt, people borrowing money, institutions borrowing money to buy more stocks, to buy more real estate, to buy more other things. We are at record levels of margin debt, and this doesn't include leveraged products, which are booming. These leveraged ETFs, that will not end well if the stock does not perform. And then finally, inflation. I'm sure you're feeling it a little bit. I'm certainly, as you come home with groceries and there's less and less, inflation is slowly ticking back up. And that's also going to be hard for the Fed to lower rates significantly because that's going to raise our stocks and raise our housing prices and raise our commodities. And that's going to be harder and harder to afford things. And this inflation number is going to keep ticking higher. So, final item, the government debt, even though we control the currency and the printing of the currency, as the US dollar is at the moment, likely still the global world currency. There's a lot more people who are trying to go after gold, as we've been investing in, but $38 trillion, dollars, that doesn't include unspoken debts. Social Security, Medicare, Medicaid, that's not in here. So there's an enormous amount of debt that the US owes interest on. So there's a lot going on. And I'm not saying that to scare you, but I'm saying that for having diversified strategies. Because if you think about it, if you keep doing everything the same with all of your money, then we want to, as IWR Advisors progresses, and we thank you so much for that, to deliver to you diversified trend following strategies. So some will be the trend roadmap that you're used to. We're developing and working on and implementing new strategies as well. So if you want to talk about that, please reach out. Some have even tighter risk bands. Some have looser risk bands to try to grab more of the market share of a kind of an overheated bull market. So we have a lot of different things in the that we're working on really tirelessly after the market closes. And then finally, financial planning. We just think it's so important. As important as the investments are some of the decisions that you make. And we're here for you as a fiduciary, as always, with your best interest. So as we end this video, I wanted to share with you some thoughts just to think about as the years, anytime a year ends, it's always worthy to say, could you, if you can, have you maxed out your 401k, 403b, or your IRAs? That's always, sometimes it takes that extra nudge, but if you can put more money into something like a Roth IRA, if you qualify, more money growing tax-free for you, more money growing tax-free for your heirs, which is wildly nice. And the nicest gift of all is tax-free growth. Have you maxed out your HSAs? It goes in tax deferred, it grows tax free. If you take it out for healthcare, it's tax free. It's amazing. You can actually lower your taxes. If you are of age, just do not forget to take out your required minimum distribution. I've probably reached out to you already, and I will continue to do so before the year ends to take out your required amount out of your retirement account. If you have any money left over in your flexible spending account, if you can't roll it over, consider spending it on something that's important to you for health purposes. And then finally, if you've done extraordinarily well in one of your positions and you do want to give that to charity, don't sell it. Give the shares if it's in a non-retirement account so you can lower your taxes and in essence give them that they deal with a low basis. So even if it's like your favorite stock of all time, you can go buy it back. You can raise your basis. But if you give those shares, it's a very efficient way to give to charity if you're already doing so. So things just for your thought process for the end of the year. All right, so I'm going to stop there. I want to say first, thank you again for being a client. It really means the world to myself, to Catherine, my wife, who is actually part of our business now. She's been helping us. So we are officially a mom and pop shop. And to Mike, and his family, we want to thank you for on behalf of both of our families. We appreciate you. We care about you, not just your investments, your plan, your entire financial life, and your family. So if we can be of help, please reach out, and then I'll keep reaching out to you too. Again, enjoy your day and talk soon. Bye bye.